Hey, so once again, very warm welcome to all of you in today's discussion on transpricing method. I am CA Gaurav Garg. In my earlier discussion, we covered the meaning of tested party and how we use tested party practically when you are doing transpricing assignment or transpricing compliance. And today we would be discussing transpricing methods, which are important, and how to use these methods practically while working on transpricing assignments or while doing transpricing compliance. This this session is available on my YouTube channel. So you can go to my YouTube channel whenever you want to hear it again and enjoy the session. And also, if you have any query in between, feel free to raise your hand. At the appropriate time, I will unmute you and will take up your query. So briefly, before coming on to the transpricing methods, the process of transpricing is when we have a transaction between group companies or related parties or associated enterprises, the Income Tax Act in India and most of the income tax laws of the developed countries and developing countries, they want that taxpayer should submit an arm's length report to the tax authorities in the respective countries. Additionally, if I talk about India, in India, under the Companies Act also, the transaction should be at arm's length, and also under the SEBI LODR regulation, which are applicable on the listed companies, they need to justify the price to the board. Now, how it works, when there is a transaction between group companies, we need to compute the arm's length price, and before going to the arm's length price, what you do, you try to understand your client, you try to understand the group to which it belongs, what the value addition your client is doing or the entity is doing to the overall group, what are the transactions, what are the intra-group transactions, what are the nature, whether it is a purchase or sale of goods or provision of services or intangible transaction or financing transaction, or maybe any other transaction, and what functions in that transaction the SSE has done, your client has done, or the other entity of the group has done. Based on this analysis, you classify your entity. When we say classify, for example, let's say you are involved in manufacturing. I'm giving you the order, you are doing manufacturing for me. But there could be difference. One, let's say you are acting as a contract manufacturer. Now I'm giving you specific design. I'm giving you type of material which you need to use, quantity that you need to produce. You are acting as a contract manufacturer. On the other side, you may be an entrepreneur. You are manufacturing and we are just buying. Then there could be toll manufacturer. Similarly, we could have different level of distributors. You may be owning the brand and you have outsourced the manufacturing work to someone else, or you are simply a distributor. I'm giving you the goods, you're going in the market selling the goods, or you may be a slightly upper level distributor wherein you are involved in creating the brand or doing the marketing exercise also. Or you simply may be a commissioner agent. You are finding the customer, you are getting the commission, you are not taking the delivery of goods. So we need to classify, we need to identify if you are a manufacturer, which level of manufacturing activity you are involved in. If you are a distributor, which level of distributor functions that you are doing. Similarly, you could be a service provider, you could be a full-fledged service provider, you could be a contract manufacturing unit or contract service provider. For example, let's say you are a software company developing software in India, and you have a US company, you have a company outside India. Now that company may be taking the contract from the customers directly and subcontracting the work to you. So does it mean that it is a marketing arm, or does it mean that I am a contract service provider to that US unit? It depends upon which entity is doing what functions. So if all the IPs, all the technical know-how sits with India, and US entity is only in a very competitive environment trying to do the marketing, then maybe the IP sits in India, and we may say that, US entity is acting as my marketing arm. Whereas, let's say, the US entity is the main entity, they have got marketing intangibles, they are reviewing what you are making, they have the head and brains, they are sitting in the US. So one may argue that, the main entity is the US entity, and Indian entity is indeed the contract service provider or the contract software development unit. Based on this classification, we move, to take the tested party, which I've discussed in detail in my last video, which you may find on the YouTube. And then we try to benchmark this transaction using methods. Now we have 5 methods. And additionally, few of the jurisdictions, including India, they give the 6th method. Even the OECD talks about the 6th method. And the 6th method is basically, to give the flexibility to the taxpayers, that if these 5 methods are not applicable because of one or another reason, you may try to justify yourself by using the 6th method, which may be of your choice, but fundamentally it follows the arm's length principle. Now, the very first, or these 5 methods are comparable uncontrolled price, CUP, resale price, RPM, cost plus method, CPM, profit split method, PSM, and transactional net margin method, TNMM. Now, whether you are in India or outside India, believe me, what I'm going to say will remain the same. Whether you're working on some UAE assignment of transpricing, or whether you're working on some assignment of Singapore or assignment of Australia, fundamentally, these 5 methods across the world remains the same. They will not change. But yes, depending upon facts of the case, one may have a different view. It's very subjective, but subjectivity depends upon how much facts and figures you have. The more facts and figures you have, the less subjective it becomes. But if you have less facts and figures, the more subjective it will become. So always try to have more and more information. What I'm going to share today is generic details about the methods, and it's for the academic purpose. I would request, when you are actually working on the assignment, kindly look into the facts, and if required, take the opinion of an expert in your case. Starting with the very first method, comparable uncontrolled price. See, every method in TP, talks the name of the method, suggests what you will going to do in this method. So the first method is CUP, comparable uncontrolled price. Means it has something to do with price, and that price should be comparable, and that price should be uncontrolled. Interestingly, we always say that we compare price, correct? But what is price? Price is the result. Price is the result of various terms and conditions on which buyer agrees to buy and seller agrees to sell. So let's say, you want to sell some property to me, or in the market, I visited you, we had a discussion. Okay, so after going through your property, the locality, how much it is built up, what is the build-up area, what facilities, the property is giving, then we will come to a price. Okay, this is the price I would comfortable. So before we compare the price, we need to compare all those terms and conditions, all those factors which are impacting the price, and then you can compare the price. Interestingly, not every factor may have equal, impact on the price of that particular product. For example, let's say, if I talk about the shelf life. So shelf life of, let's say, mobile phone, whether you are buying the mobile phone in the morning or in the evening, the shelf life remains the same. So if you're buying mobile phone at 11 o'clock, and if you're buying mobile phone at 6 o'clock, or maybe for that matter, 9 o'clock in the evening, the price will not change because of the shelf life. But if you're buying pastries at 11 a.m. in the morning and pastries at 9 p.m. in the evening, because of the shelf life, the price will change. Now, if I come to quantity, if you're buying, 10 grams gold or 20 grams gold, or for that matter, 500-gram gold, the price will remain same. But if you are buying 10 kg banana, 500 kg banana, the price will change. Similarly, you may be able to better negotiate if you are buying 10 mobile phone or 500 mobile phones. So what I want to bring home, that price is sensitive, but yes, not every factor may impact the price. Now, what becomes important is that, say you sit with your client, the one who is in the sales department of your client, or the one who is in the purchase department of your client, and try to understand what are the factors which are impacting the price. And you need to jot it down. And if let's say you are saying every month the price is changing, your purchase will suggest that yes, every month the price is changing. So there is something, which is changing the price every month. It's just that, we are flipping the calendar pages and price are changing, or there is something, which is dependent. It may be a seasonal product. It may be a metal commodity. So, depending upon, but a car price will not change every month. It is made of a metal. So friends, what I want to bring it home is that cup apparently seems very easy, that we can compare the prices. It is very easy, but practically it is very tough to apply. And you can only, in most of the cases, what we have seen, one is able to apply cup comparable uncontrolled price method when there are internal comparables available. Now, what are internal comparables? Broadly, there are two types of comparables. One is internal comparable, second is external comparable. Internal comparable means when you get a comparable transaction from within the group. Always remember, one entity will be in the group and another entity would be outside the group. So there should be uncontrolled transaction. Transaction which you are comparing would always going to be between two unrelated parties. But yes, one of the party to the transaction, they both are, let's say there is a transaction between A and B, both A and B are unrelated, but it could very well happen that A is related to you. And if A is related to you, it is internal comparison. When A and B both have entered into transaction and both are not related to you, then it is external comparison. So it is like, if you see the jurisprudence, if you see the OECD, they all said that internal comparable should be preferred over external comparable. The reason is simple. If there is a transaction available within the group, you will able to get better information about the transaction. It is other matter that the party or the group may not want to share the information, but yes, for a matter of fact, the information availability about the internal comparables are always better than the external comparable. For example, one may say that let's say Mr. X provides audit services for rupees Y amount. But what is the Y amount? Okay, we know Y amount is there. But in that Y amount, what is the credit period? Whether that credit period is 15 days, whether that credit period is 30 days, 45 days, although data is not available in the market. But yes, if it is an internal comparable, you can get the term sheet, you can check how quickly the invoices have been paid, and you can come to know what is the realization period or what is the credit period in this case. What are the terms and conditions? All those information are available when you have internal cup available or internal comparable transaction available, but not always the case of external comparable. Now, if you see the availability and how sensitive the price is, let's say if now I want answer in the chat box, you all must be having a chat box and it is enabled. So the question is, let's say you are a manufacturer. You are a manufacturer based out of Japan. You have a group company in India. That group company is involved in distribution of machines which you are manufacturing. During the year, you supplied 100 units of that machine to your Indian group company. also you have a client base in India. So few of the clients said that instead of buying from an Indian company, we would like to directly buy from a Japanese company. And during the year, you have also supplied the machine to directly to the customers in India. So my question to you is, can we compare the transaction? Can we compare the prices? That is a transaction between Japanese company and Indian company, vis-a-vis Indian Japanese company and Indian group company, vis-a-vis Japanese company and customers in India. Can we compare the prices? Please reply yes or no in the chat box. Now we have got 3 answers. Any more, any further answer, whether can we compare the prices or not? So Nitish is saying yes, Piyush is saying yes, Nikhil is saying yes, Simarjeet is saying yes. Any further answer before I share my view? So now I have got another question for you, that the Indian company, as I told you, Indian company is a distributor. They are buying and supplying to the customers, and your customers are final consumers. So a price given to a wholesaler by a manufacturer can be compared with a price given to a final consumer. Nitesh bhai, if answer to this is no, you cannot compare price given to an Indian company, which is indeed a distributor, with a price given to a consumer. So not only, the product, but also the level of the entities in a transaction matters. Piyush is saying after adjustment, but Piyush, after adjustment you can compare, but whether can you do the adjustment is a big question. For everything we cannot do the adjustment. Adjustment can be done for something which are simple, for which reasonable and accurate adjustment can be carried out. Maybe freight charges, maybe packing charges. I think for everything, adjustment is not possible. For intangibles, for this level of differences, how you will do an adjustment is a big question. So in my view, in this case, we may not be able to compare the transaction. Now, if you have any question on cup, you may please raise your hand, and I would be happy to share my view with you. If you have any question on cup, please raise your hand. So now Nitish is saying, so sir, you can say cup is more relevant to compare when all criteria are similar. Yes, Nitish, you can only compare the prices when all the comparable factors can be compared. And if there is a difference, you can carry out adjustment. But if factor, for example, if somebody asks you that price of an apple in Shimla is X and price of an apple in Shimla is Y, can you compare? The answer is no, because of the location differences. Similarly, the price of umbrella in summer vis-a-vis price of umbrella in rainy season vis-a-vis price of umbrella in winters would be different. You cannot compare. So all the factors which are impacting the price are very important. So you need to figure it down. What are the factors in your case which are impacting the price, and then only you can apply cup. Many a times when client comes to us, even our friends who comes to us, we have seen they apply cup in the form 3CB, that okay, my client is doing services for related party and unrelated party, let's apply cup. Or maybe we can find the data of cup in the open market. Have faith on me, it's very tough to find a data of cup in the open market. So for example, you are providing a software services or you are providing an accounting services, tell me, which is the authentic document available in with you, which says, okay, this is the price charged by Mr. X from Mr. Y, or Mr. X entity from a Y entity. There is no authenticate document. There may be some industry publication, but question comes whether on that industry, based on that industry publication, people are fixing price or not. So there may be a couple of articles, which you got, but what is the authenticity of that article, and how that articles are valued in the market? Whether people are relying upon those journals, whether people are relying upon that articles or not. So, for example, if you are dealing in a commodity which is listed, or you are dealing in a commodity for which regular publications are available, weekly publications are available for the price which was there and for the forecasted price, maybe if that publication is accepted by the industry people, that may become a comparable, otherwise not. So now I will take few of the questions. Any ideal scenario or sector industry in case CUP would be suitable? So Nikhil, first of all, CUP most likely when you have internal comparable available, when you are supplying goods or services to a related party and unrelated party, and both are comparable, at the level of operation also. Or if you are buying from your related party and your related party is also supplying to a third party, maybe you can compare. When you don't have internal comparable available, external are generally when you have a listed commodity available, maybe you're dealing in oil or maybe coal or maybe metal, for which you can get a price from the exchange. Ankit is asking, sir, but we are defending our price by comparing with our own group companies by following CUP. Will it not be a question that data of our own group company can be manipulated in favor of us? No, Ankit. So it depends, whether the transaction is one of the transactions. So for example, if I correctly got your question, so your question is, when my group company is supplying to third party, what is the authenticity of that data? And that data can be manipulated. I totally agree with you. So Ankit, it depends upon the volume. So for example, my 90% of my transactions or 99% of my transactions are within the group. So there is no uncontrolled party. They're all controlled transactions. But 1% of the transactions are outside the group. So in such case, one cannot place faith on that 1% because that can be manipulated. But think of a situation wherein there is no volume, the volume difference is less, maybe 60-40, maybe 30-70. In such a case, depending upon case to case, one may be able to use that 30% as a comparable. So for example, let's say you are supplying to your group companies, not one, maybe 5 or 10, and that constitutes 70%. Whereas you are also supplying to third parties, which constitutes 30%. So possibly, we may see the quantity level at from each entity perspective. And if that satisfies, we may able to compare. For example, I was working on one fertilizer client, wherein it was supplying to its group companies, and also it was supplying to unrelated parties, and the group companies were distributors and unrelated parties were distributors. So while doing the analysis, what we saw that, if let's say, for example, on an average, they're supplying 10,000 units to the related party. Maybe the related party based out of North India, they're supplying more or less the similar unit to independent parties. But from an overall perspective, supply to related parties were 60% and supply to unrelated parties were 40%. So we are able to freeze that, yes, CUP can be used in this case because good quality of data is available, and that too in a quantities. We have a lot of transactions available to place faith, and being they are with the related parties and being the volume is good, I think that cannot be challenged. So you may able to do tweak with 1 or 2 parties, but not with number of parties. Hope, Ankit, I am clear on your question. Any other question on CUP before I move to resale price method? Okay, so now let me take up the next transfer pricing method, which is resale price method. And I said earlier, कि from the name you can make it. When a naam में कुछ बात है. So from the name you can make it. Now in this case, name hints it's related to resale. It has something to do with the resale price. What is resale? When you are buying and selling. When you are reselling. When you are buying from your group companies and selling it to unrelated parties. So here, the very important concept of tested party comes into the picture. And I would request you to kindly check my last video, which is available on the YouTube. Therein, I have discussed the concept of tested party. And in this case, we need to do the functional analysis of the tested party. And in this case, RPM is applicable. Resale price method is applicable when tested party is involved in distribution of goods or services. So when tested party is buying from the group companies, is buying from the associated enterprises and selling it to independent parties or selling it to third parties, then you can apply RPM, resale price method. Because who is doing resale? Tested party is doing resale. But one very important point which we need to remember is, in this case, tested party should not add significant value to the product or should not do a lot of marketing functions to create intangibles or to manage the brand value of those intangibles. So it is like plain vanilla distributor, not doing much functions, and you are giving a functional return, and you are saying, okay, your gross margin should be 5%, 7%, and how we fix? We find a comparable transaction. That comparable transaction may be internal. That is, there is, the group company supplying to somebody else, and there is one group company which is buying from a related party and selling it to independent party. So what is the gross margin that group company is earning from the third party? Similarly, it can very well happen that, let's say, let's take an example. Let's say jeans, you're buying jeans, trousers, from the group companies and supplying it to unrelated parties, whereas you are buying shirts from unrelated parties and supplying to unrelated parties. So on one side, you have a controlled transaction in the matter of jeans, whereas in the matter of shirts, you have uncontrolled transaction. So you can compare the gross margin. So the assumption, which we take in resale price method, that when you are comparing the prices in the cup, there the product level differences matters a lot. But when you travel to RPM, more than a product level, functional level differences matters a lot. So in this case, you may not be able to compare the prices because in one transaction, you are buying the jeans, in another transaction, you are buying the shirts. You cannot compare the price, but your function is same. You are distributing, you are buying and reselling. So we can compare your gross margins. So generally, let's say as a distributor, if other things remains the same, your price for selling a pen or a pencil or a sharpener or a pen or a scale would remain same. Whether you are, supplying, let's say a particular model of a car vis-a-vis another model of a car, the margins would remain the same. So that's how the resale price method works. But yes, it also depends upon the level of functions that you are doing, your inventory holding period. So in one case, let's say if your inventory holding period is 10 days, in another case, your inventory holding period is 100 days. In that case, you cannot compare the gross margin because, see, the gross margin, if you see the distributor, which is earning the gross margin, that gross margin indeed is a remuneration towards the distribution function which he is doing. So he is buying goods for 100, let's say selling for 120, he is gaining 20 rupees. But the 20 rupees is towards the value addition function which the distributor is doing. So whether he is doing stocking or not, whether he is doing marketing or not, how big is the administration is required, what kind of commission he needs to give pass on. So for all that, he is getting rupees 20. Now let's say we have two distributor A and B. One distributor is doing a lot of functions. Another distributor is doing no functions. He's just buying and supplying and the inventory holding period is less. The another distributor, let's say Mr. A, their inventory holding period is 100. They need to hire, a big celebrity to do the marketing, or maybe just putting a banner and doing a roadshow. So that distributor, Mr. A, would like to have higher gross margin. So at a gross level, you will see his gross margin may be high, maybe higher in comparison to Mr. B, who is doing low level of functions. So now in RPM, the functional comparability becomes important. I'm not saying that product comparability is not important. Certainly, you cannot compare a distributor of an oil with the distributor of a shirt. So you should compare the product. Product should be otherwise compared. They not be similar, but yes, they should at least belong to same industry. They should have same fundamentals. For example, one may say that can I compare the fruit? You can compare the fruit, but the pineapple cannot be compared with apple. You know, it does not mean that we cannot compare pineapple with apple because pineapple has got pine, apple does not have a pine. It's not like that. The shelf life of pineapple is different from the shelf life of an apple. The care which apple needs, maybe pineapple does not needs. So the functions which you may be doing for selling or distribution of an apple would be slightly higher in comparison to the functions that you're doing for distribution of a pineapple. So possibly because of this, there would be difference in the gross level margins. And unless you can carry out an adjustment, to my mind, even if both are distributors of product, you may not be able to compare the gross margins. In another case, let's say one is buying and selling, another one is developing the brand, making the product more visible. Again, because of the functional level differences, we cannot compare the prices. In general, RPM is easy to handle. You can, if you are a distributor entity, you can see your functions. You can see the functions of comparables. And I think P&L speaks. I always believe P&L speaks. If it is well drafted and documented, profit and loss account will tell you what functions the other entity has performed. If the level of expense, type of expense are common, you may assume that functions are common, and you may compare the gross margins. More importantly, I would like to highlight that, let's say if you're a manufacturer, so let's take it as a question, and I would request you to share in a chat box. Let's say you are a manufacturer of watches, and you have a distributor entity in Singapore. So now you are manufacturing watches in India. You are also selling watches in India and other Asia Pacific countries, including let's say Sri Lanka, Bangladesh, and you also have a distributor entity in Singapore. Now, when you are supplying these watches to Singapore entity, which entity you will take tested party and how you will justify? If can anyone would like to come and share his view how you will justify this transaction? You may raise your hand and I would be unmuting you. How to justify this transaction or how to apply RPM in this case? So in this case, one may see comparable and controlled price because you may be selling this similar watch or comparable watch in other countries, and if there are no geographical differences or because of the geography there are no price differences, maybe cup is applicable. But if let's say the model is different, the model which you are selling in Sri Lanka is different from a model which you are supplying in Singapore, then we may take Singapore entity as the tested party and can benchmark the gross margin earned by Singapore entity. So this is how RPM works. And if in case you have any query on resale price method, please share in a chat box, or maybe you may raise your hand and I would be happy to answer. Any query on resale price method? Okay, so now moving to another method, cost plus method. So just one thing, I think if I've skipped in resale price method, the profit level indicator is gross profit by sales. This is what you compare. Now the next method is cost plus method. Again, as the name suggests, हमेशा से नाम में कुछ बात है. It is cost plus. And what should be that cost? That cost we generally take is direct and indirect cost of production. Now, in resale price method, you must have seen that what I was talking, that tested party is buying goods from related party and selling it to unrelated party. Correct? Tested party was buying goods from related party, that is the cost was coming from a related party, and selling it to unrelated party. Whereas in cost plus method, it is a tested party which is supplying to related party, buying from unrelated party. So it is a reverse situation. In RPM, tested party was buying from a related party and selling it to unrelated party. So sales were untainted, purchases were tainted. So we applied the profit level indicator, gross profit by sales. So in denominator, we took untainted portion, which is sales. Correct? In cost plus method, it is the reverse case. I am supplying, tested party supplying to related party, whereas buying from unrelated. So the profit level indicator would be gross profit by direct and indirect cost of production. So CPM is generally used when you are giving services to the related parties or a group companies. The tested party is giving services to the group companies or related parties, or tested party is supplying semi-finished goods or goods after doing manufacturing to related parties or group companies. In that case, you have a data for direct and indirect cost of production, and based on the same, you compare the gross margin. But the challenge with CPM, unlike in RPM, the challenge with CPM cost plus method is it is not easy to get comparable data. For example, let's say if you take up the financials of any manufacturing company, you may find a manufacturing expense, but we don't know whether that manufacturing expense, or if you take the profit and loss account, it will have following journal heads. It will have raw material cost, cost of goods sold, manufacturing expense, employee cost, other administrative expense, depreciation. So now we do not know in the manufacturing expense whether the employee cost is considered or not. But now let's say they have given a schedule for manufacturing expense, from that you will come to know, okay, whether they have considered wages or not, whether they have considered employee cost or not. So it might happen that they might have considered wages, but not employee cost. Now, if let's say the employee cost is there, total employee cost is given to you, from the employee cost, you cannot make out how many person or what cost belongs to the manufacturing, what cost does not belong to a manufacturing. Okay, what is the idle cost in your case or in case of the comparables? And similarly, from a depreciation, except plant and machinery, let's say if there is computer is used in the manufacturing, which part of the depreciation should go to direct and indirect cost of production, and which part of the cost should go to the administration? So that becomes a challenge in cost plus method. You have all the data with you with regard to your cost, but you may not have data with regard to comparable cost. That is the biggest challenge in case of CPM. So again, generally, when you have internal comparable available, let's say you are into projects, you are into construction projects, you have done work for your related parties or a group companies, and you have worked for the independent third parties also. So you will have all the data. You can compare. I think therein the CPM fits the best. So we have handled few cases wherein we have felt that when you have internal data, CPM is one of the best method to use, especially when you are providing services to group companies. So especially in the project-based work, I was working on one of the assignment wherein the company was having almost some 60 odd projects, 50 to 60 projects. And out of this 50, 60 project, almost 40% of the projects were for related party or group companies, and the balance were for unrelated party. So we applied the internal CPM, and we got the data. We did a deep analysis on the cost allocation, because you might be booking few costs very safely, and maybe the travel cost you are not taking very seriously. So you need to sit with the accountant and identify how the costs are booked and whether the booking is proper or not. And from there, you after sanitizing the data, maybe CPM becomes the good method when such kind of facts are available. Otherwise, we generally avoid CPM based on the external data because of the issues which I told you earlier, because the cost breakup is not easily available when you do external comparison. So we prefer TNMM in that case, and I will come to that. So all the comparability that we have seen in the RPM, that products are not much comparable. You need to focus on the functional comparability. I think that is what is important in case of cost plus method as well. So this is what about cost plus method. If you have any question with regard to cost plus method, please let me know. You may please raise your hand, or if you want to put it in a chat box, feel free to share in a chat box. Okay, so now let me move on to the fourth method, which is transactional net margin method. So I generally say, one needs to make three columns. In the first column, write CUP, comparable uncontrolled price. In the second column, write RPM, CPM, and TNMM. That is resale price method, cost plus method, and transactional net margin method. And in the third column, write profit split method. So profit split works differently. RPM, CPM, TNMM works differently, and CUP works differently. So now I'm in my second column. I have already discussed resale price method, cost plus method, and now we're discussing transactional net margin method. As the name suggests, it has something to do with the net margin, and it has something to do with the transaction. TNMM does not mean company as a whole. Company as a whole profit, it does not mean. There are different benchmarking approach. And when what benchmarking approach is applicable or not, that is, I think, something important to understand. So TNMM, what we do in TNMM is we compare net profit by any relevant base. And that relevant base may be sales, that may be cost, that may be fixed assets, depends upon facts of the matter, facts of the case. So for example, let's say in the case of distributor, you are not able to compare the functions, because of the availability of data, or because you feel, this entity has done slightly higher function, and adjustment may not be possible at the gross level. So what we do, we compare at the net level, because at the gross level, there could be difference in the gross margin. But if you come down and if you compare at the net level, that net profit has already taken care of the expense incurred by different parties. So same thing in CPM, because in CPM, cost plus method, we are seeing that we don't have the breakup of employee cost because of the accounting issues. One entity may be treating particular cost at a gross level, another entity may be treating such cost at a net level. But when you apply net margin, all those differences get adjusted. All those minor functional differences get adjusted, and you can compare the net profit margin. So that's the beauty of the TNMM, that the functional differences, the level of functional comparability that you needed in RPM and CPM is not required in TNMM. But it does not mean that you can compare anything under the umbrella of TNMM. See, transactional net margin method is still a method wherein you are giving some return to the tested party. In RPM also, what we are saying, the tested party should earn this much of a return. In CPM also, we are doing the same thing. In TNMM also, we are doing the same thing. We are benchmarking the profits of tested party, which is the least complex entity. Least complex in the sense, the functions done by the tested party are routine functions, and one can expect a routine return for those functions. It is like investing in a stock market vis-a-vis investing in a fixed deposit. You can justify or you can benchmark the FD returns, but you cannot benchmark the equity returns, because the risk which you are taking in particular stock, is different from a risk which you may take in the another stock. But whereas fixed deposits are generally the risk free. So one can compare the returns on FD and not the return on stocks. Same logic I apply to TNMM, that if there are routine functions, you can compare the profits. Otherwise, you cannot compare the profits. Let's take an example. Let's say one distributor is doing a marketing function, a basic routine marketing function, putting up a banners on or hoardings on the streets or in the markets, which you may, expect from any distributor to do. Another distributor has hired a celebrity to do a marketing. He's spending a lot of money. So now both are doing marketing, but the level of risk which they have taken in doing functions are different. Both are doing marketing functions, but one is investing a lot of money on marketing, on a building of brand. The other is investing a very, normal level of marketing, which you expect anyways from a distributor to do. So now in the first case wherein the distributor is doing normal marketing function, we may apply TNMM. But in the another case wherein the spend is such that it is increasing the brand value or it is maintaining the brand value or intangible, in such case, we may not be able to apply TNMM, transaction net margin method, in my view. Same thing happens in the CPM. So as I said, TNMM is not a company as a whole. I feel there are two approaches. One is a transaction by transaction approach. At every transaction, you try to benchmark. Let's say, you have bought goods from China, and so you may apply cost plus method or TNMM by taking Chinese entity as a tested party and not Indian entity as a tested party, because Indian entity is buying and supplying. Indian entity may be involved in the brand building activity also. But then if you have entered into 3-4 kind of transaction, maybe purchase of raw material, manufacturing. So should we benchmark purchase of raw material separately? Should we benchmark manufacturing operations separately? The answer may be yes, if you have the availability of data, or you may want to apply company as a whole approach, benchmark the profit, because you may say that, the manufacturing operations may, if we would benchmark, we will have a purchase of raw material also. So instead of benchmarking separately, we will benchmark the profits of this entity. And it may very well happen that you are a distributor or you are a service provider and you are a captive unit. So 100% of your supplies are to your related party. So whether to justify profit of every transaction or should I justify profit at the end? I think I will justify profit at the end. Because in one transaction, I may earn 100 rupees extra. In another transaction, I may earn 100 rupees less. What matters at the end of the year, after doing all the transaction, what is my net profitability which is coming? So that's how you apply TNMM. In TNMM, in RPM, we compare gross profit by sales. In cost plus method, we compare gross profit by direct and indirect cost of production. And in TNMM, we compare net profit by any relevant base. Again, TNMM and RPM, if you ask me, any third-party comparables do work. You can do a benchmarking search on comparable database if you do not have internal comparables available. And based on the comparable search that you have done, you can compare the functions. You can see what level of marketing spend you are doing, what level of marketing spend your comparables are doing. Similarly, you may compare the warehousing function. So we may compare a lot of functions from the P&L, and if you feel these functions are routine functions and not generating a lot of risk or generating brand value, one may proceed to benchmark the transactions using transactional net margin method. But yes, for sure, I think the correct application of TNMM is very important. Sometimes we have seen, let's say, the turnover of a Indian company is 100 crores, and one of the transactions with the group companies is management fee, which may be 5 crores. So we try to benchmark management fee by applying a TNMM and benchmarking Indian profits. I think that is not a very correct position, because when you have 100 crore sales and only 5% of the management fee you are paying, applying TNMM is not justified. Maybe we may take foreign entity as a tested party. You may justify, first of all, you should document the services, yes, that you are in receipt of services. First of all, this we need to justify. And second, the price which I'm paying for the management services. So we will evaluate, what are the functions, what are the costs incurred by that entity, that foreign entity, and what is the profitability charged by that foreign entity. And we may take foreign entity as a tested party and benchmark the profitability of a foreign entity. I think that would be a much better approach than taking Indian company as a tested party. Reason is because, because of the Indian operations, Indian P&L is very dynamic. You may be able to sell goods, you may not be able to sell goods, you may have your own efficiencies, So profit may vary. In 1 year, you may have 15% profit, in another year, you have 3% profit. So does it mean that, in 1 year you are at arm's length, in another year you are not at arm's length? When the management fee charges more or less same. So I think in such case, we should take foreign entity as a tested party. I think that would be a better approach. Again, I think what needs to be preferred are, the internal comparable over external comparison. So if you have, you're supplying goods both to your related party and unrelated party, and if there's a transaction, with group companies as well as with unrelated parties, I think one should try to benchmark internally and try to prefer internal comparison over external comparison. Certainly, the volume of the transaction would also depend. So this is about TNMM, transactional net margin method. If you have any question till now on any of the method, feel free to ask.
Hey, Gaurav. Hi.
Yeah, hi,
Hello.
Raman.
Yeah, I just wanted to ask you the last example which you quoted.
आपकी voice नहीं आ रही, Raman. Can you be a bit louder? I'm not able to hear you.
In the last example, you given about the management fee one.
Yes.
Am I audible?
हाँ.
What will be the good benchmark to do that? If you are paying a 5%, suppose a management fee to the foreign company, and the foreign company is not comfortable in sharing us the financials of its financials, so what will be the best benchmark to do?
No, Raman, see, if the foreign entity is not ready to share the data, the financial data, we cannot take foreign entity as a trusted party. So in order to benchmark, let's say if the agreement says it should be at cost plus 5%, and what you are benchmarking is the 5 based on the agreement, I think that agreement may not be the only document on which we can place faith unless the agreement is supported by the numbers, and that too audited numbers. So first of all, I would like to see that there should be some, certificate from an independent accountant, quantifying the cost and the markup. Then only, because what you are benchmarking is, say, let's say cost plus 5 means you are benchmarking 105 and not only 5. So first of all, we should be sure about that. Yes, there is 100, and that 100 should not be 90. It should not happen that on 90 you earned a 15% markup, because what you are benchmarking is 5. So first of all, 100 should be the cost and 5% should be the markup. If the foreign entity is not sharing the data, I think then you can highlight the risk. You can always say, here the better approach is to take foreign entity as a trusted party, but if you are not sharing the data, then the secondary approach is to take India as a trusted party and benchmark. So, but that comes with a risk. That the officer may reject this approach. But as a consultant or as a Indian team member, I think one should at least highlight this issue to the group companies.
Okay, thank you.
Okay, any other question on any of the methods that we have discussed till now? Okay, so now we are on the last method, profit split. And after that, we have rule 10AB also. So we have one question coming up. Sir, in a given transaction, which method is the best among the all? How to identify such? Because it might be possible for transaction, there are more than one method. So Nitesh, if there are more than one method available. I think if in one of the more method cup is with you, cup seems to be the best method. It should be preferred over other method. But generally what I've seen, if there are more than one method available or can be applied, and if the data quality is good in all the cases, I think in such a case, you should have a same result whether you apply RPM or TNMM or CPM, the result should be same. That is, you should be at arm's length. If a result is coming different, I think then you should have a valid reason. But yes, the hierarchy in Indian law, there is no hierarchy. But yes, in some of the jurisprudence, CUP has been preferred over the other methods, RPM, CPM, and TNMM. And RPM and CPM are preferred over TNM. So it will not happen that where PSM is applicable, TNMM can also be applied. It will never happen. But yes, where RPM can be applied, TNM can also be applied. Where CPM can be applied, TNM can also be applied. But if you have a cup which can be applied, then we will prefer cup over any other method. In the given transaction, certainly either CPM or TNM will work. I would like to take foreign entity as a tested party because that is the least complex. I am the more complex entity. So I would like to go with taking foreign entity as a tested party and benchmark the profit and cost of the foreign entity. Because we would be relying upon the external data and not internal data. I'm not sure CPM would be a preferred method. I think we'd like to go with the TNMM transaction net margin method, taking foreign entity as the tested party. I hope Nitesh this clears and how to identify. I'll give an example. Whenever you wish to identify, start from cup and try to see which method you can apply. You will get yourself a good answer. But yes, something comes from practice. So the more you practice, the more you're going to grow in this area. Now hope Nitesh, I'm clear. Now let me move on to the other method, which is profit split. So as the name suggests, it has something to do with the profit, splitting of profit. And unlike the other methods, resale price or a cost plus or TNMM, wherein you benchmark the profits, wherein you identify the tested party and benchmark the profit. In profit split, you do not identify the tested party. Reason is, in profit split, we say, for the sake of simplicity, let's assume there are only two parties in the transaction. So both the entities in a transaction will be holding some intangibles. They are bringing some intangible on the table. They try to work jointly, and so the profit that will come, is a result of joint efforts put in by those entities. For example, let's say at a broader level, there are two kind of intangibles. One is the product intangible and another is the marketing intangible. Product intangible, something to do with the product, the technology of a product, the look and feel of the product is product intangible. Marketing intangible is the brand name of the product or the trademark, or the customer list is the brand name or marketing intangible. Now let's say we have entity A, which puts a lot of money on R&D, which develops the product. And then we have an entity B, which has got good customer list, which keeps on pumping the money for the building of a brand. And now the entity which has developed a product, maybe the laptop, is sold by entity B by putting a brand name of B. Now, when the product has gone into the market, it becomes hit. So my question to you, what is making the product, why the customers are buying product, this laptop? So when you buy a laptop because of the technology, or you buy a laptop because of the brand. So my question, if you can reply in a chat box, when you buy a phone because of the technology, the features, or you buy just, you are a very brand specific person. Why you buy a laptop? Why you buy a car? Why you buy a television? Because of the technology, because of the features, or because of the brand? Just one answer. Is it marketing intangible? If you buy a product because of the marketing intangible, that is because of the brand presence, right? MI. If you buy because of the product intangible, the technology, right? PI. If you buy because of both, right? B. So why you buy a product? Because of marketing intangible, because of product intangible, or because of both? Friends, please share your view in a chat box. So we have one answer. We have another answer. So few people may buy because of the technology. The one who's very technical, who can do the R&D in the laptop, he might buy because of the technology, but he might say, I'm not sure about the customer after sales support, and I would like to go with a established brand which has got after sales support. So one may go with the both, or one may simply like me, who do not know much about the product, who put faith on the brand. यार Dell का है तो सही होगा यार, है ना? So one may be like me, like me, who believes in going with the brand rather than technology because I'm not much of a techie guy. So friends, in such a case, you cannot remunerate the other entity simply on a cost plus model. I cannot say to manufacturing entity, hey, look, you take cost plus 10%. Or that manufacturing entity cannot tell to a distributor, hey, look, you take 20%. So in such a case, you come up with a profit split, wherein both the entities, they hold some IP, they hold some intangible, which are non-routine. They are not routine intangibles, they are non-routine intangibles. When they are non-routine, you cannot give them a routine remuneration. You need to give them non-routine remuneration. And that non-routine remuneration is indeed the distribution of profit. For applying the profit split, you do not need any comparable. But yes, you need data from both the sides, because there are two ways to apply the profit split. One is the total profit split, wherein you identify the total profit in a transaction, and then you divide the total profit split, maybe on the employee, maybe based on the R&D expense or marketing expense, or maybe based on the employee cost, or maybe some other key factor. And then the another method is profit split. One is the total profit split method. Another is the residual profit split method, wherein first you divide the normal profits and then you divide the abnormal profit. So after dividing the normal profit, you get the residual profit, which you divide among both the entities. So generally, PSM, we have not seen, we have practical application of PSM is slightly tough. Because entities are not ready to share data too much, and that's the prime reason for non-application of PSM, because the volume of data that you need and the quality of data that you need are generally not shared by the groups. So this was on the PSM, profit split method. Any question on profit split? Now let me take you to the last method. Last method is any other method, rule 10AB we have in India. There is a flexibility also given in the OECD. So now, for example, let's say you are, selling the brand, or you're transferring your trade name or trademark to your group company. Now that transaction is unique. You will not going to sell it to another else. Because you are selling to your group company. So no cup is available. It is not a reselling transaction. It is not a service transaction or a manufacturing transaction in which you can apply CPM. You cannot apply PSM. You cannot apply TNM. Then what to do? So there could be other transactions as well. Maybe transfer of intangibles, transfer of customer list. So in those cases, you value them. You do the valuation, or maybe some purchase of unique asset. You do the valuation and apply. You try to justify the transfers by not using any of these 5 methods, but yes, by using some technique which is at arm's length, maybe used in other cases, because in other cases also, when you transfer the brand, you do the valuation. So if your valuation are based on the fundamental principles of which are used to value the brands, maybe that becomes comparable itself, and that is what we have any other method. So now, friends, I trust you must have got clarity on the application of 3P methods. If you have any query for me with regard to transfer pricing methods, feel free to raise your hand, or we are done with the day. So now this discussion is available on my YouTube channel. You can go to my YouTube channel and watch it or share it with your friends if you want to. So thanks to all of you for joining, and see you in the other session. Thank you. Do share your feedback. Thank you.